Hey, welcome. We just got the closing bell for Monday, February 26th. Earlier this morning, we were talking about how we were likely not going to be able to make a new high today. That psychological resistance point that we have at the 510 area would probably hold given all the weakness that we were seeing in the markets. And so that we were either going to chop sideways or come down a little bit. And it looks like the market chose to come down a little bit. And this is a tiny bar, just like on Friday, it was a tiny bar. So not a lot of movement, not a lot of volatility. We can see right now that the volume was just super low, or currently at 39 or 40 million. And by the time all of the dark pool stuff, all that gets tabulated, we might be at 50 million. And that's quite a bit lower than the 80 or so million that we're used to. So not a lot of participation. One thing that we didn't look at in the morning video was the economic reports that are going to be coming out. So we could be waiting for some of those. But really, this market is tired. It's been going up for so long. We had this huge burst from NVIDIA earnings, and it just can't keep that up without, at the very least, a pause. So we're not sure yet if we're going to chop sideways or if we're going to come down and retest that uptrend. But right now, it's looking a little bit more like we're going to come back and retest that EMA 20 and this uptrend line right here. We'll take a look at what else we can see to support that or to kind of discredit that theory, but for the most part, I don't think we're going to find too much. We'll take a look at our economic reports. We'll take a look at all the rest of our indices, and then we'll make our conclusions from there. So S&P 500 starting to pull back a little bit, but again, very mild, little baby range in price action and also very low in volume. If we look at the QQQ also pulled back to the previous day lows, so not as bad as the S&P. So S&P made a lower low than the previous day. The QQQ still matched, or at least not quite matched, the low of the previous day. So very much more sideways movement in the QQQ than the S&P 500, but again, very low volume right here. If you look at the Dow Jones looks a lot more like the S&P 500 than it does the QQQ. Just a very mild pulling back so far. We'll see if it actually gains any legs. Let's take a look at the small cap stocks. Small cap stocks doing well, actually gaining today, up 0.68%. So that's kind of interesting to note, given that small cap stocks are more of a risky asset. So that's kind of interesting. We'll take a look at sectors to see if we can find out any information over there. It could also be sort of earnings driven because a lot of the companies that are left are the small to mid cap stocks. So that could be influencing the IWM, but not really the broader market. Okay, so let's take a look at TLT as well. TLT pulling back down, so really just moving. It's looking like it might get caught in a channel again and just start moving sideways, which would be supportive of everything that we've seen so far. Just either a sideways movement or mild pullback that may later develop into a larger pullback. Let's take a look at our sectors. Is this the right? No, that's the wrong. Okay, so today, semiconductors on top, small caps on top, energy, retail, consumer discretionary, and technology. So things on the day, it made sense. All of these sectors are related, or they're higher risk, high growth type of sectors. And then we've got our financials, healthcare, communications being down here doesn't make a whole lot of sense. Staples a little bit middle of the road. So it looks like we are back to our old pattern. Last week we were more defensive sectors, and then this week it's looking like tech is leading again. So we've been bouncing back and forth for at least a couple of months now. That pattern, at least so far on Monday, is reestablishing itself, but I'm not going to get too excited about it because we had really limited range today and very low volume participation. So even though, yes, these higher risk type of sectors did outperform on just on today in today's session, really we're not, nothing moved that much. So we're not going to get super excited about it. And it's not too surprising given that what we saw in the QQQ is that it only pulled back to its previous day lows or previous day open, and the S&P and the Dow Jones actually went below the previous day's low. So this also, the fact that even though those sectors led, the QQQ was down on, or well, flat, completely flat. So it's not like they moved up and they're like those sectors are strong and everything moved up. It's just those sectors are strong and we're only just maintaining the exact same price that we had previously. So it's not that strong. It's not that something to get really excited about. Let's see. Oh, our calendar. We'll look at our calendar and then we'll go back to the sectors to see which ones are leading or which appear to be leading, just like we did this morning. We want to see if that picture changed. Which ones are leading and which ones are weakening. This morning, we said XLU looked really weak. It was actually the only one that I identified that looked even like that had any sort of weakness to it. And it was the bottom sector today, and it went down 1.71%. So we'll see if any others look weak after today's trading session. The XLU, yeah, really started to come down today. That's a larger than normal bar that we see over here. In the economic calendar, we've got tomorrow, we've got consumer confidence. That will be important. Then we've got GDP on Wednesday. So we got some pretty important reports that are coming up here. So that could be another reason why we're pausing, because earnings are out of the way. The major earnings are out of the way. We pretty much know exactly what the Fed is going to do. So anything now that is foreseeable will most likely show up in the economic reports. So the markets will look towards those reports to kind of decide what direction we're going to move in. So probably not just off of consumer confidence, but once we hit GDP, it's possible the market gets some direction, or we'll get a stronger reaction of either moving up or moving down. The personal income and outlays, this could be really important because we have the core PCE right here, and that is what the Fed uses to its main measurement of inflation. So right now we've got our consensus at 0.4%, meaning that we're expecting prices to go up, but year on year to come down. Now, if it just maintains, now this isn't a huge difference, but if we don't come down, if we just maintain or if prices go up year on year, that is going to send markets straight down, because that means that there's even less likelihood of us getting a rate cut anytime soon. We're already not really feeling it in March or May anymore. And then in June, we've got about a 60, 58, 59, okay, about 59, 60% chance of a rate cut. So if that report causes this number to shrink significantly, then we will have a downward motion in the markets. We can see that S&P, it just very slowly and steadily moved downwards today. Not a huge amount, but that's still a very strong trend here. No attempts whatsoever to break that movement. It's just one direction the entire day. So there is definitely weakness happening in the markets right now. Yes, we are very close to all-time highs and things look great, but there's just a lot of signs that things are weakening. And again, we don't want to jump ahead of ourselves. We don't want to start pointing our portfolios downwards, but just be prepared and say, hey, a movement back down to this EMA 20, we would consider that a normal event. What would happen to my portfolio in that normal event? If I lose a whole bunch of money, and that's a significant amount compared to my portfolio, then I know that I am not sized appropriately for the risk that's in the market right now. So I would want to start adjusting that. Now, moving down through the EMA 20, that's a different story. And that is where we would want to start putting hedges. We don't want to put hedges on right here because it doesn't make a lot of sense unless you're just extremely pointed very bullishly. And for whatever reason, you don't want to close or adjust your positions, then yeah, you could throw on a hedge, but that's not really, I would say, gold standard practice in terms of portfolio management. The normal good quality portfolio management would be, hey, if it comes down to that EMA 20, I'm fine. It's a normal event, and then we would expect it to bounce back up, and then we'll gain on the way back up. And then if it falls through, then I'm hedged for that event, so I'm perfectly okay. Rather than saying, oh my gosh, it's a bull, we're on this uptrend, let me point everything bullish and allocate so much money that if I have a normal movement in a day or a normal movement on that weekly basis or on this daily chart, what is considered a normal movement, it's absolutely devastating to my portfolio. That wouldn't make a lot of sense. If I got this day, just single day, okay, this was normal movement. It's not, no one panicked here. No one did like this, or no one did this. No one panicked recently. No one panicked right here. But if that represented a huge drop in your portfolio, like I have a $10,000 portfolio and I just lost $1,000 on this day alone, then I'm not appropriately sized. So you don't want to hedge just because you're positioned poorly. you want you to be positioned well, and you want your portfolio to absorb the normal pullbacks, and then hedge yourself for the larger than normal pullbacks. So the 5% move, not the 2% move. So just for now, we want our portfolios to continue to be pointed upwards. We want to be very selective about the sectors. We'll take a quick look at that, see if anything changed since this morning. Retail is looking very strong. That we didn't identify that this morning. Yeah, I would be in retail. Staples looks beautiful. Healthcare, beautiful. Financials, beautiful. Any of those sectors to the upside, I would completely avoid the rest. And it looks like to the downside, it's still only just utilities. So utilities, if you wanted to balance out your portfolio to make sure it's not completely pointed straight upwards. If you didn't want to do it in terms of allocating your size appropriately, but if you wanted to do it in terms of the positions that you're holding, then you can throw in some XLU in there to balance out any positions you have in XLF, XLV, and XLB is looking okay. What was that? I is actually looking very good. And retail is looking pretty good. So for now, we're just going to keep our portfolios pointed upwards. Right now, we should be allocated in a way that a mild pullback, 2 to 3% back to the EMA 20 should be no big deal. And then when we get there, then we will consider some hedges. But for now, there's no need for your portfolio to be hedged unless you have a weird risk you took a position that is kind of outside of your normal portfolio parameters. So oftentimes when we create a portfolio, we have our bread and butter trades, and then we take some outside risk trades. And if you wanted to hedge those individually outside of the rest of your portfolio, then yeah, of course, it's always appropriate to do that. But in terms of your overall portfolio, there's not a huge reason to be hedged unless you're just hedging against a black swan event. So everything is looking like, I guess the change from this morning, I would say, is that we are a little bit more certain that we're going to pull back and challenge this EMA 20 or this trend line rather than just chop sideways. And it's looking like it could happen probably maybe this week, but probably in the next by mid next week, we may be challenging this EMA 20 once again. Okay. All right, guys, that is going to be it for today. We are just cautiously moving forward and just waiting to see what happens in these markets. Have a wonderful rest of your day, and I will see you tomorrow morning.